So, you want to learn bookkeeping. Merchandise Inventory. By Dave Marshall. Costing Methods. Both the perpetual and periodic inventory methods require you to calculate and attach cost to the ending inventory. Knowing the quantities on hand is only half the battle. If the purchases of items were always made at the same cost, which is not the real-world case, our job would be simple. Use this cost and multiply by the quantity on hand and you'd have the cost assigned to the item. Since this is not normally the case, purchases are more often made at various prices, we have to determine what costs are assigned to our units quantity, on hand, ending inventory, and what cost are assigned to our units quantity of items sold. So our problem becomes, what cost do I use to value my inventory when my business has made purchases of the same item at different costs? Let's use an example. Example. Product, super widget. Purchases, quantity. Unit cost, $100. $10, $300, $9, $200, $11. Do I use $10, $9, $11, an average, or what to assign cost to my cost of goods sold and/or ending inventory? I know, you're probably wondering what the heck is a widget. I did too when I was taking my introductory accounting courses in college. A widget is just a term used to mean any type of product imaginable. So many times, instead of using a specific product such as toy dolls, lawn mowers, etc. in examples, we just refer to our product as widgets. Costing products in a nutshell. Calculating and determining costs assigned to ending inventory and cost of units sold is really just a matter of applying some good old logic and common sense. Costing inventory basically just involves 3 steps. 1. Select a methods of accounting for inventory. Periodic. Perpetual. 2. Determine the total product costs and total units to account for. 3. Assign costs to ending inventory and cost of goods sold based on a consistent method of valuing inventory costing method. Specific identification. FIFO first in first out. LIFO last in first out. Average cost. Class dismissed. Just kidding, although that's all that really needs to be done, but I realize that we still need to learn how to do it. We discussed the periodic and perpetual inventory methods earlier. Now, we will concentrate on the methods of costing and hopefully enlighten you as to what the methods are and how to use them. Let's first discuss the different methods and their calculations. Costing methods described. Cost flows. Specific identification. If we could, the best matching of our revenue and costs would be accomplished by determining the specific cost of the item that was sold or that we still had on hand. For some high-dollar and uniquely identifiable items this can easily be accomplished. Can you think of a few product examples? How about automobiles, boats, and custom jewelry to name a few? These items usually have a unique product ID identification number assigned to them. In the case of automobiles, all vehicles have a unique serial number. What about items that are exactly the same? This makes identifying which items were sold and which are still on hand difficult. If we bought them at different times and at different prices, how can we easily determine which units were sold or on hand? Not by looking at them, they all look exactly the same. Due to the fact that in most cases it's hard to determine what specific item was sold, we rely on some assumptions, when it's not feasible to use specific identification, for determining which items were sold and which are still on hand. These assumptions are referred to as cost flows or costing methods. The following cost flows or methods, FIFO, LIFO, and average cost, are used in practice to assign costs to ending inventories and cost of items sold. What do we mean by flow? The flow refers to the flow of the cost of inventory items into the business when items are purchased and the flow of the cost of inventory items out of the business when items are sold. What the heck do those strange abbreviations mean? FIFO is an abbreviation for the first in, first out method of assigning costs to ending inventory and the cost of items sold. The FIFO inventory method assumes that costs are matched with revenue in the order in which they are incurred. In other words, the first goods purchased are the first goods sold. The effect of this method is that the most recent costs incurred remain in the ending inventory while the first, oldest costs are used to assign costs to the goods that are sold. Costs assigned using FIFO to our beginning of the year inventory, earliest purchases, are assigned to goods sold first, and then cost associated with the first, oldest purchases during the year period are used to assign costs to the goods sold. Using this method with either the perpetual or periodic system will produce the same results. The FIFO cost flow assumption actually closely matches the actual cost flow in and out of many types of businesses. Many businesses try to sell their oldest goods first. Grocery stores, if the oldest goods are not sold first, many of their products will perish, and clothing goods stores are just a couple of examples. Selling the oldest products first also helps reduce the loss from products losing value due to obsolescence. LIFO is an abbreviation for the last in, first out method of assigning costs to ending inventory and the cost of items sold. The LIFO method assumes that the last items purchased are the first items sold. The effect of this method is that the oldest goods purchased earliest and their assigned costs make up the ending inventory, while the most recent goods purchased and their unit costs are used to assign costs to the cost of units sold. In reality, there are not many instances where the actual flow of goods into and out of a business adhere to the LIFO last in first out cost flow assumption. The use of the LIFO costing method is influenced by the tax savings resulting during periods of rising prices. Due to using the newest unit costs, which when prices are rising, are higher, the costs assigned to the costs of the units sold, cost of goods sold, are higher, which results in a lower reported profit. Since income taxes are calculated based on profits, a lower profit results in less taxes being paid. Average cost, no strange abbreviation here, makes no effort to identify the actual flow of cost in and out of the business. Instead, costs and quantities are pooled, and an average is calculated that is used to determine the amount assigned to inventory and the cost of the items sold. All items in merchandise inventory at any time are assumed to have the same unit average cost. This method assumes that the same cost per unit, average cost, is assigned to items on hand and remaining in inventory as to items that were sold. IRS approval may be necessary. Estimating inventories. Most businesses, because of the time and expenses involved in taking a physical inventory, counting and assigning costs, only take an inventory once a year at the end of their accounting period. A weakness of using the periodic inventory method is that since no continuous detail records are maintained, the cost of the goods that are sold are not known until a physical inventory is taken. Why is this a weakness? I don't know about you, but I'd like to have a pretty good idea of whether I'm making money during the year and not have to wait until year end to take an inventory to find out. Without monthly or at least quarterly profit and loss statements, as the old saying goes, the horses may all have already gotten out of the barn. You need to have readily available information in order to adjust plans and take any remedial actions needed to ensure the profitability of your company. You are in the business to make a reasonable profit, aren't you? Also, no early information is available for tax planning. At the end of your year, it's too late to make any decisions and take any actions that might save you some taxes. So, if I want to prepare monthly or quarterly financial statements, interim statements, what other options are available that don't require a physical inventory? You can estimate your ending inventory. Can you think of any other reason that might require you to estimate your ending inventory? God forbid, but what if your inventory was destroyed by a fire? It's very difficult to count ashes and determine what goods were destroyed. Two common methods used for estimating inventories are: gross profit method.